Just a reminder for today's show that nothing that we say today should be interpreted or construed as investment advice. Everyone's financial situation, goals, and objectives are different. Please consult a professional investment advice. Welcome back to the Loonie Hour, episode 3. We've got the three amigos. We've got Richard Diaz here with Acorn, Acorn Research, a boutique macro research house that specializes in helping family offices, high net worth individuals, and small institutions with asset allocation and portfolio construction. And of course, our favorite boomer, Keith Dicker, with IceCap Asset Management, has been professionally managing money for 30 years. A god among us all. Welcome back, gents.
Hello. Nice to see you again, Steve.
Keith, how you doing?
Hey, good morning, good afternoon, everyone. This is great. Excited. Number 3 coming up here. And we've had some market events over the last few days. So let's have a good chat today.
Absolutely. Let's dive into it. I think, for a lot of our Canadian listeners here at the forefront of everyone's mind, and I've been taking a lot of heat for it on Twitter, the hawkish Tiff Macklem of the Bank of Canada coming out yesterday, actually, with an update on the sort of monetary policy report, basically pushing up their guidance here for rate hikes. So basically, in Tiff's words, not my own, saying that we expect to begin increasing our policy rate sometime between April and September. Of course, Rich, correct me if I'm wrong here, but I think the markets now are pricing in 5 rate hikes from the Bank of Canada in 2022. Of course, I don't agree that they'll get anywhere close to that, but is that am I right? Is it 5? Is that what we're looking at?
I think so. I think that's right, but someone will surely correct us in the comments. It's something around there.
So we had this obviously relatively hawkish Tiff Macklem basically coming out and saying, I think that they were expecting inflation now, of course, is proving not to be transitory, that they suspect that inflation will subside or get back to his target towards the end of 2022. So we got a whiles to go. I think they have it averaging around 3.5% for the most part in 2022. Keith, I mean, any sort of reaction function, any comments on your side in terms of, really what's happening with the bond market post that move? Because I think there was sort of a curve flattener, so to speak, and it looks like that's kind of balanced. So I don't know if you want to touch on that and maybe explain it to those that might not be familiar with that.
Yeah, sure thing. So I mean, there was so many things happened with yesterday's meeting, and we'll jump right into it. And we'll talk about this curve flattener that you just mentioned. And we're global, of course. We always talk about that. Canada is not an island. Whatever happens here is not in isolation. So like this movement in the bond market, it's happening all over the world at the same time. So it's really interesting. But let's jump first into what they said, what they want to do, and what likely might happen. So in our last week's show, we talked about how many rate cuts will they do? I mean, we sort of say, they'll probably get 2 in and it'll get stopped out. That's still our expectation. So first of all, central bankers, they absolutely believe they can control inflation. They believe they can do it. So as an investor, it's important for us to know what they believe. It's not important for us to say, wait, they can't control it, which they can, because there are so many other things.
I want to add as well, quickly, Keith, to interrupt you. Sorry to interrupt you, but that people have to understand it, that these guys are sort of the controllers of the currency. They have to sort of emit this strength and this faith. They have to basically portray to you that they are in control, because if they're not in control, if they say,
they're
hey, listen,
politicians.
guys, we aren't.
Say it, Steve. They're politicians.
They're politicians. They have to look like they're in control. And at the end of the day, fiat currency is a lot of it is backed by faith, and people have to have faith in governments that they can control, inflation and the value of their purchasing power. So keep that in mind. But Keith, sorry to interrupt. Continue.
Yeah, it's a great comment. So as central bankers, I mean, they know, they push the pedal down to the metal. So in March of 2020, everyone went to zero by cutting interest rates to 0%. And then they all instituted quantitative easing. And what quantitative easing is for some people, fundamentally, it's a form of money printing. Technically, it's not really. And people say, geez, like pick a side here. But what it is the central bank will literally print money, and they'll use that money to buy federal government bonds that are issued to the primary banks. And then the proceeds for that will go to the bank's reserve account at the central bank. So again, to make that even simpler to understand, all the debt being issued by the federal government, it's being bought by the Bank of Canada with made up money. Where the inflation guys get the story wrong, they think that money is going directly into the marketplace, but it isn't. It gets jammed at the central bank. It doesn't do anything. The money goes into the economy when you get what we call credit creation. So RBC, BMO, all those guys, they need to say, hey, we have confidence that we can take that, lend against those reserves and put money out and let people buy houses and then boats and trucks and stuff like that. So that's what that whole thing is.
That's an important caveat. So to interrupt, per the Bank of England, basically they've come out and they acknowledge that money creation, I think it's like 98% of all like new money that is created into circulation is basically through commercial bank loans. So it's basically when RBC creates a new mortgage for you to go buy a house, they are creating money into the financial system. So about 98% of all money is created through commercial banks issuing new loans. So just to, anyways, Keith, continue.
Yeah, it's great. So the real exciting thing about the Bank of Canada meeting yesterday, and again, we think central bank meetings are exciting because that's what we like. Thanks, Rich, for the laugh there.
That's funny. It's true. It's true.
But as we talked about before, these guys, they know what they have to do, and they're at 0% rates, and they're doing QE. They know they have to stop. So by definition, the next move is to stop. And by definition right now, the economy, it's we can talk about how it's in really good shape or not very good shape, but the point is it's not plummeting, it's not declining. So and prices are going up, inflation is up, stock market is high, the housing market is good. Like there's so many reasons for central banks around the world, not just Canada, to say, hey, let's try to start creeping out of this corner that we painted ourselves into. So that's what they started to do. So, I mean, the first step is you say, hey, we're not going to do any more QE or quantitative easing policies. They're not going to reverse that. Now, that's a really big step to do. Instead, they'll just continue to sit on all the bonds they're holding and roll them over. And that's still incredibly helpful for the.
Can you explain that process for the just typical listener here that might not be overly familiar? Because we did get a comment as well. About the show here that they were asking, okay, so the Bank of Canada is stopping QE. They're no longer doing QE, but they're going through a quote reinvestment phase. Do you want to explain that reinvestment phase?
So let's pretend three of us here. I'm the Bank of Canada. Steve, you are the federal government. Okay, you're the Minister of Finance. And Rich, you are the commercial banks.
Private industry. Thank you, Keith.
Yeah, you're the bankers. So here we go. Steve, you need to borrow money because you're spending way too much more money than what you're collecting in taxes. And you call up Rich and you say, Rich, I need to borrow $3 billion. And what do you say, Rich?
I say, as long as you don't deregulate the banking sector in Canada, I'll let you do whatever you want, Steve.
Okay, so now you're confusing our listeners here. So
sorry.
So Steve is going to borrow $3 billion from you. And then as soon as you get it in your door, you immediately turn around and you call me at the Bank of Canada and you say, hey, Bank of Canada, we just bought $3 billion worth of bonds from Ottawa, and we'd really like for you to buy them because you're doing QE. And I say, yeah, thanks, man, sure thing. I take the bonds from you, but instead of giving you $3 billion in cash, I put it in your bank account at the Bank of Canada. So I've been doing that now for a while. I've been doing it every month for almost 2 years. And so now I have billions and billions of dollars built up in bonds issued by Steve, which are held in your name, Rich. So what's going to happen right now, I'm going to say, you know what? I'm not going to buy any more of these bonds. So Rich, if you buy any of these bonds from Steve, you do whatever you want with them. Meanwhile, all these bonds I have, some of them are maturing on a weekly basis or monthly basis. And when they mature, instead of me taking the cash, from Steve, because he has to pay me out, I'm just going to reinvest that money in the bond market. So I'm no longer buying bonds with quantitative easing, but I'm not selling them either. And that's the key here. That's the key step. So once again, with the central banks, guys, for everyone to realize, they paint themselves to a corner. The next step is to try to move out from the corner. So they do that by saying, hey, we're no longer going to, print money, as they would call it. And you know what? Next year, we might start raising rates. And that's where they ended yesterday.
Scary. Rich.
Cool. Well, I was going to say, I was just going to add a couple of things to the QE thing. It's not just, so just a couple of things. I mean, if you ask the BOE has written loads of papers on it, there's just a couple of things that I think are important to know. Quantitative easing is also, there's a signaling effect. So literally by executing on these transactions, there's like literally, it's called a signaling effect. They're telling people what their interest rate policy is today and what they expect it to be in the future. And then the other thing that Keith will be familiar with this is portfolio rebalancing. So as the bond prices go up and the yield because they're bidding up this asset and the yields necessarily goes down, it effectively will force certain investors, certain asset holders to rebalance their portfolio sort of away from these quote unquote risk-free assets into riskier or higher yielding portions in the yield in like the offering. So you might move away if the Bank of Canada bonds used to offer 4% and now they only offer 1%, but you need, let's say, a 4% yielding instrument. You'll move along the risk curve and you'll start to purchase, let's say, investment grade bonds and then hope maybe, eventually high yielding corporate bonds. So that's like the portfolio balancing element. And then there's just the brass tacks, the facts of just lowering that interest rate, which is the other bit what I wanted to add.
Rich, are you able to comment as well? Because you put some really good charts on Twitter, which we'll put them up here for the show. But you've highlighted, I think since 2019, how much with a percentage of basically the Bank of Canada has been essentially funding the federal deficit. And I mean, can you comment on that? Because I think as right now, the Bank of Canada came out and said that the Bank of Canada owns 46% of the entire government of Canada bond market, 46%. But you've been following that really closely. So, I mean, any comments on that?
Yeah, sure. I can't remember exactly. So if you say 46, I believe you. Don't skewer me for getting the exact numbers wrong. But what is important is basically from June 2019, because Canada was, roughly, was running a deficit, but it wasn't crazy and things were going relatively okay. The way I've sort of looked at it is I calculated what was the increase in bond holdings held by the Bank of Canada. And I looked at the increase in debt issuance, the net debt issuance from the government of Canada. And for a long time, it was basically 1-for-1. And that goes beyond what I would consider QE and shift into what I would consider MMT, modern monetary theory. But basically the chart looks, it's a Canadian chart. It looks like exactly like a hockey stick. It's flat and then it just kicks up and the two lines move up together and we'll show. And it's not perfect, of course, because it can't be perfect. These things are never exactly, they don't work that well. But basically for the last almost, 18, 24 months or so, the Bank of Canada has purchased about 80% of every dollar issued. And Steve's, he's too polite. I mean, I think that's absolutely crazy. Just to give you sort of a reference point, the U.S. government purchased about 55 or whatever, 56, depending on the day, of course, % of all the debt issued. And so, basically you're in a situation where the bank, and then why that's important is it because it obfuscates the reality of the decisions that the government of Canada should have on its own bond market. And only governments that have quote unquote hard currencies or have institutional kind of respect or like bureaucracies that are well regarded can basically get away with that kind of bullshit. Because if Venezuela did that, or Uzbekistan, or some country, many of us maybe never heard of, you just can't get away with that kind of stuff. But in Canada, everybody's like, oh, we could trust the Canadians not to screw their currency up. And that's why, interest rates have been able to be pinned down. I think just to relate it to something that's going on in the world. I mean, if you look at the Aussie, what's happening in Bank of Australia, the Reserve Bank of Australia, I think that they said, we're not going to buy any more. We're not going to buy any more bonds, basically, which is not quite true. But anyways, and you could see what happened to that yield. It spiked, and so that's the reality. You cannot run deficits of 10, 12% year after year with no growth and have your interest rates be pinned to the floor. And because they're effectively, it's an admission that there's a buyer strike. It's admission that your government policy, this is maybe I'm editorializing here, and Keith might have a different view, but it's an admission that, your decisions, right or wrong, from a COVID standpoint, sorry to bring the C word, are just not respected, and people, market will not tolerate that kind of basically money printing to just basically give people cash handouts. And this is where, the QE switches to MMT. In the past, you had central banks buy government bonds in order to hold interest rates down and to increase the excess reserves of the banking sector. That money, was spent either to shore up, to, let's say in TARP, for example, is TARP, in the US in 2008, 2009, George Bush, or I can't remember who it was, maybe it was Barack Obama, I think it was George Bush, he basically signed the TARP, and it was a targeted asset relief program, and they went and bought a bunch of stocks of, let's say, the auto sector and whatever. That turned out to be a profitable decision for the US government. The difference between now is they basically just, they ran a huge deficit, issued loads and loads of bonds. The Bank of Canada came over the top, purchased 80% of those bonds to keep interest rates low. So basically, you're lying. Whenever you mess with the price, and Keith, you'll like this, is like you're not reflecting the true appetite or how people genuinely feel about that asset. And remember, yields are effectively the inverse of a price. And so you're just keeping that price down. And so what they did was they basically handed out that money to Canadian citizens. I mean, not me. I wasn't living here at the time. I would have loved the check. I would have loved $14,000, but, and you could say, well, Rich, we had to keep, you had to keep the economy going. Okay. That's maybe true, maybe not true. Loads of, similar countries with similar wealth had much, much lower, it's not necessarily clear that was the right thing to do, but it was done. And it was basically financed almost entirely by the Bank of Canada. And that's where I think it moves from something like a strictly quantitative easing, which is defined by the Bank of England, and you can read loads and loads of nice papers about that, to something sort of like a modern monetary theory, where you're running deficits to hand people cash, and the Bank of Canada is basically financing that deficit.
Keith, what do you think? What are more importantly, what are the market implications now, as well as as the Bank of Canada says, okay, we're no longer, going to do QE, we're going to do this reinvestment phase, but, hey, well, hold on a minute. You guys, as Rich has just, explained here, they've basically funded the budget deficit. And I don't think the Trudeau government is going to suddenly, balance the budget anytime soon. So, I mean, what's your view here in terms of, how this plays out for the Canadian, the bond market in general?
Yeah, I mean, I think first of all, we'll all agree that balancing the budget is that's for chumps. So no one's going to do that. But the other thing that's really important to know is, just as the Canadians are effectively buying their bond market, the Americans are doing it. The European number, it's above the American number. Could be high 60s at this point.
It's higher, Keith. It's like it's in this high 70s, low 80s.
High 70s, yeah. So I did the same exercise about a year ago, and then you look at the Japanese, they're well over 100%. They might be 140, I think, something like that. Yeah. Which means they're buying all the new issuance, plus they're buying issue and sell by the private sector at the same time. And then if you look inside within Europe, for example, like that's happening within specific members of the Eurozone as well, like Italy, for example. So it's not just Canada doing this. So it's important to know what everyone else is doing. Because with Canada, if you're just looking at this on its own, you say, man, Canada's a basket case. Like there's no price discovery. The yield curve is being artificially suppressed. I like to say that word all the time. But it's happening all over the place. And so what this means now coming up next year, where everyone else, they're saying, hey, yeah, we're going to end QE. We're going to signal that we want to raise rates. And it's not going to happen, guys. Like especially the Europeans, they will not be raising rates. So we can bookmark this page and come back a year from now. And
I'm glad I'm not the only one, because I was getting absolutely roasted on Twitter. That everyone's see 5 rate hikes coming, and I just says, listen, like you might want rates to rise. It might be the moral thing to do, but I don't think the system can actually stomach without triggering off
in your defense, Steve, I just want to say something really quick and then I'll pass it on. But in your defense, Steve, like virtually for the last 10 years, there's this really famous chart that's always done by Bank of America, Merrill Lynch. And it looks like some kind of sea creature. And you've got the Federal Reserve Fed funds rate that ticks down. And then you've got all these dotted lines that come off of it. Okay. And it's tough to describe. And it's basically, those Fed fund futures, either instruments, whether it's OIS or whether it's the 30-day Fed fund futures, that don't skewer me, I'm forgetting the names wrong. But those instruments basically are always much, much more hawkish than what eventually happens. And I would just think it's important that people sort of kind of remember that's true. Anyways.
So let's come back next summer and we'll see exactly how many rate cuts these guys are going to be able to do. But more importantly, from this Bank of Canada meeting, so they said, hey, inflation will go up a little bit more, but they think that the rate of growth is going to slow. So we're going to move from 4 or 5 down to 2 to 3. That's what they're forecasting. They're also forecasting growth is going to slow as well. So if we get the whole world signaling that they want to raise rates, and they're going to reduce QE or just, go in. It's a form of tightening. It's going to be highly unlikely the world can withstand 12 months or 9 months of these actions taking place or inactions taking place. And we'll be, for a year from now, we'll be right back to the point where they're doing QE again. Now we're talking about negative rates. I mean, again, you have to understand. So the ECB, one thing that's outstanding about the ECB, and if you ever listen to any central bank pressers, that's the one to go to. Then that's the one.
That's the European Central Bank.
Correct, the European Central Bank. I didn't watch the one this morning. I was doing something else here, but I mean, they're just outstanding. They talk off the cuff, but one thing they do, they always. To give an example, my kids a few years ago, they were watching this show. It was like The Hunt for Bigfoot or something like that. Do you ever see that? It's a great, really great show. But they're tracking down this big hairy guy, and they all at the end of the episode they almost see him. They just lost him. He just gets away, and of course you got to come back next week and see it again. That's what central banks are like, especially the European Central Bank. They're telling you, yeah, we're going to do this. We feel confident in the economy and everything. They keep you hanging on, and then the next meeting will come, and the next one, and so forth. But the point is, with the Bank of Canada, they're not like the Europeans. They're not as wishy-washy with it, but they're not as deep in a hole as the Europeans. So they will very likely, they want to raise rates. They will absolutely try to raise rates, and they will do it until the market tells them they can't do it. And the one metric for everyone to watch, it's not equity markets or even the currency world, it's credit spreads. So because risk is not allowed to be reflected in the world government bond market, look for it to happen in the credit space, credit spread world. So it's corporate debt for everyone here who's watching. That's where it can explode higher. And if that explodes higher, guess what happens with your mortgage rate in Canada? Steve, where's it go?
It's going up, which means prices are coming down. But that's kind of, as Keith says, it's these central bankers and their QE programs and zero interest rate policy. It's like the Hotel California. You can check out anytime you like, but you can never leave. But just to transition here, because, you know, a whole part of this, you know, inflation story. Hey, you know, inflation's hot. Bank of Canada, you have to do your job. And 2% inflation target, you must raise interest rates. You know, one of the reluctance to do that has been, well, it's how much of this is due to supply chain issues, particularly, you know, in China, which is still running a COVID zero policy. I mean, I'm kind of curious to hear your guys' thoughts here on China, because I think that from a global macro perspective is playing a huge part in kind of forcing, you know, central banks' hands to, hey, you might have to react here. We don't want to raise rates, but my gosh, inflation is ticking higher and higher, and a lot of this is due to global supply chains and you know, shipping issues, particularly in China. So.
Yes. So just 2 points on China. We'll dive into it. And so first of all, China is incredibly important for Canadians. And the reason it's important, because really they represent that, you know, that incremental increase in consumption around the world, on the commodity and as well as on the output side. So if China runs into problems, it's going to, you know, leak all around the world. So it's incredibly important. The 2 points with China that, you know, we can talk about is, one is, you know, what's happening domestically from an economic perspective, and then you have that whole you know, geopolitical risk that are definitely escalating, involving, you know, the Chinese and then the Russians and the Americans. And, you know, of course, we had the AUKUS or AUKUS, what do you want to pronounce it? What's the AUK US, you know, between the Americans and the Brits and then the Aussies, you know, with the submarines. But there's a lot of things happening right now with China that Canadians need to be aware of. So what are you seeing domestically, Rich, with the Chinese story?
I think it's definitely part of that supply chain. I think it's also just it's a function, I think, of what the COVID policy. I think we need to sort of admit that in some ways it was like a resounding success, and in some ways it was the, you know, past is prologue. I sell that T-shirt on my website, you know, just for fun. But the reality is, you know, you can't constrain people's ability to go to work in the manner that we did systematically throughout the world, and then give them a bunch of cash in an environment when they can go online and buy stuff. So, you know, those are, so, and then expect, you know, hopefully we'll share this chart. You get a situation where, you know, you can't leave. So all the spending on services, you know, craters, and then takes quite a bit of time to recover. But the spending on goods explodes, right? Why not? You're at home, got, you know, some time on your iPad, you can't leave the house. What do? You go on Amazon, you buy stuff. And if you look, whether it's Canada, I know it's to be true, and I know it's true in the US, you know, you've got a situation where those jaws opened, right? You've got services that are in person, restricted, but then the spending on goods went up. And the reality is that everyone did that at the same time. And you basically, and where do we buy, you know, all of our goods from? China. You know, and so you have a situation where, yeah, it's a supply chain, but it's also a function of just like, you know, the store's out of, no, there's no more lemonade at the lemonade stand. You know what I mean? And not only that is like, you have a situation where that's so that part's true, but then also, you know, everyone on Twitter has been really excited about this on the way up. And it seems it's funny how it's, you know, crickets on the way down, but the cost of just simply shipping those goods from the largest global exporter in the world, China, to everywhere else has gone up 5, 6, in some cases 6 times, depending on, and how do we calculate it? There's a couple of ways. There's the Shanghai Freight Index, you know, that's up 4 times. There's the HARPEX freight index, a similar kind of thing. Then there's something called the Baltic Dry Index, which is an amalgam of the different types and sizes of ships. That, you know, one of the ships is called a Panamax because it's the largest ship that you can ship through, you can send through the Panama Canal. And so not only do you have, you know, the supply of goods has gone down, demand has, you know, exploded, and then you have the cost of transporting those goods has exploded. And so that's why, you know, so that's why, you know, if you look at durable goods, for example, in Canada, it's up 6% year on year. And you can see, you know, things that have basically the price of goods that have been falling for almost 2 decades, basically since China joined the WTO. you're finally starting to see some increase year on year and over 2 years. And so it's I hate when people try to boil it down to just one thing. I think it's many things. It's the stimulus package, it's the China zero rules. I mean, my friend of mine he just went to China. He teaches in Harbin, which is north of North Korea, and he has to quarantine twice. Once getting into Shanghai for 2 weeks, and then once going from Shanghai within China, you have to quarantine from Shanghai to Harbin. And so, you've got the situation where, the supply just refuses to get unlocked, partly because of things, because people are not able to just live their normal lives. Companies are not allowed to normal lives. But again, the key, I think also the really important thing for me is the demand side, where you've had that stimulus just go right to goods because you cannot exploit the services of your neighbors and of the high street. So I don't know how you feel about that, Keith, but I think it's just never one thing.
Yeah, there's normally more than one thing. So I mean, our view on China. So first of all, we didn't talk about Evergrande too much last week, I don't think. So for everyone who's here, it's a huge property developer. They levered up a lot, and all of a sudden, they're now defaulting on their debt. So in fact, for the US dollar bonds they missed the last 3 payments. So it's pretty bad. And then you have other property developers. They're also defaulting. The equity side, it's getting hurt as well. The reason that we look at that, and we're sharing that with everyone here, is that everyone looks at the Chinese economy and they say, hey, it's a miracle. And it's not a miracle. So I remember back in the 90s, I read this book. I think it was called like The Four Tigers or something like that. So it was basically about, the Southeast Asian countries, and they were booming, they were going nuts. Of course, then they all crashed back in 97. And, the book talked about the culture, they all work together in harmony, and, they're young and eager and all that. And you're like, I'm reading this, I'm like, holy smokes, how come everyone else isn't doing this? This is beautiful. And then you realize years later, no, it wasn't that at all. It was debt. It was debt on top of debt on top of debt. So they're borrowing all the time. And that's what's happened with China. So China's been leveraging up their economy now, like over the last 20 years, and especially over the last 12 years. And now it's to the point where the only way they can continue to achieve the 6 to 8%, they used to be at 10 or 12% growth here a few years ago, is by continuing to borrow. But what's happening, what Evergrande is showing us, is that all of this borrowing, it's creating unproductive assets. And an unproductive asset, it's literally that, the ghost town that you see. The cities are built with no one in them, and so forth. So the Chinese government, they have to make a choice right now. They have to say, hey, let's start realizing these losses internally. It may not creep out directly to hit other markets, but it slows the domestic economy, and it reduces their ability to grow quickly. So I suspect that the Chinese economy, they're no longer going to be growing at that 5-6% number. It'll be low single digits. And when you have that happening, that affects the rest of the world in the global economy. So that's important to consider. Again, the Chinese, they're really struggling now with billions and billions in unproductive assets, which are creating losses. And it's not going to be replaced with more unproductive debt.
Keith, so I want to jump in there because I think that's like important to note. So, if you get like a slowdown there, obviously that's, a global impact. So that starts to stem the Bank of Canada's hawkish forecast for rate hikes, for one. But number two is your buddy. I think we can all agree, probably a pretty smart guy, Mike Green. You can follow him on Twitter, but I was listening to a podcast with him the other day, and he said something that kind of intrigued me, was that, particularly for myself, because I work in the Vancouver real estate market, which is, benefited tremendously from the flows from China, particularly over the last 5 years, is that he feels like they're kind of adapting this policy of nobody in, nobody out, trying to sort of contain flows. And Rich, I don't know if you could comment on that. I know you're tracking the data, but I think it's kind of come down to like this, Mike was talking about this whole COVID zero policy, which is like, hey, every time we get a COVID flare up, you shut down the ports. That screws everything up. And this kind of just they're kind of closing up shop here, and how's that going to impact? We circle back to Canada, but I just look at that for our housing market here, anyways. Is that we've seen people always ask me, oh, Evergrande, and what about the Chinese? Just wait till we reopen the borders from COVID. They're going to be coming here and dumping a whole bunch of money. Well, I can tell you from a property market perspective here is that, they're not really buying. If we look at any of the high-rise developments, the luxury pre-sale developments that are selling downtown Vancouver at $2,500, $3,000 a square foot, they're not moving. So those flows out of China, at least into our property market, are not what they used to be, 4 or 5 years ago. So, I don't know, Rich, if I'm missing the point here, but
no, I think that there's two things there. One, quickly, I think the idea that China, for example, has a closed capital account, I just think that that's false. I think it hasn't really ever had a closed capital account. You say, Rich, how can you be so confident about that? China's current account balance is about 340 billion US. That's an annualized number. There's something called, I love it. It's my favorite stat probably. It's called net errors and omissions. You say, Rich, why is that important? And normally it isn't. Normally for an economy that you can trust their data with extreme faith. Let's say the US, Italy, Japan, Germany, and these developed countries, you have a net errors and omission that is two things. One, it is extremely, extremely small relative to the total and relative to GDP, for example. And two, it's mean reverting. So you get, net error emissions just bounces around zero. Sometimes it's positive, sometimes it's negative. You say, Rich, why are you dwelling on it? For China, the net errors and omissions is negative 206, I think was the last time I checked, billion US dollars. That's an annualized number. So it's almost 60% of the current account balance. And so I think you're right, Steve. And I think, how does that money sort of leave? And I think that money leaves with, feet on the ground. And I think that, relates to your point about, people aren't bidding up on these things because people were doing it with cash. I mean, Sam Cooper, who's a journalist who I think should get the Pulitzer Prize equivalent in Canada, wrote a whole book on basically the abject corruption that is people in Canada basically turning a blind eye to these massive, massive flows. And how did these flows come in? They came in duffel bags. They came with like squeaky bums on planes and people walking into the BC casino.
You're gonna get us kicked off of YouTube.
I'm sorry, but Sam Cooper's a respected journalist, and everything I've read like excerpts from his book, and the guy should be lauded for his work. But I think that that's the issue. I think that when you have this COVID zero policy and you literally can't leave the country, I think it affects those flows. And just to push back a little bit on Keith's view of China, I'm much, much more like tactically bullish on China. I wrote a note called "Be a Bull in the China Shop" a month ago, basically saying, history, I think, doesn't, people say it rhymes. I hate that expression, but I think that it's important to just remember a couple of things when you're, those of us who may or may not be negative on China with respect to different industries. We've seen this before. China's policy is blunt and it leaves scars. In 2010, they were trying to basically get into, the equivalent of the COP, some kind of climate change meeting. They shuttered all kinds of high energy, high emission industries before the climate talks. In 2012, there was the corruption crackdown. You were not allowed to give watches. There was literally vineyards in France that went bankrupt because they couldn't sell enough champagne, because for years and years and years, all these Chinese businessmen would basically gobble up all these bottles of champagne and hand it over to, officials, corrupt or otherwise. I'm sure they were on the level. You've seen these kinds of, and to me, the Evergrande blow up is a symptom of what we saw a couple of years ago. And, with all due respect, I think we've all sort of forgotten it. A couple of years ago, they said, listen, the real estate market's crazy. We need to do something about it. And 2 years later, I think, right or wrong, again, I think that they have spent a lot of money building unproductive assets, but I think it's the Evergrande is a symptom of that policy. And I think it's just another one of those. And so the idea, people were talking about the Evergrande being the start of Xi Jinping's new cultural revolution. I push back on that view. I think it's just another one of this. It's what these spikes, that's what happens when you have a command economy. You get these blunt tools leave scars.
Keith?
Let's just share a story with you. The world works on stories. So that's what you do. So I worked offshore for some time, and I'm at the airport once and bumping this older Canadian guy who was working construction on the island. He come down for a month and go back again. And and the guy's name is Bill, really nice guy. And I said, Bill, what are you doing? He's, oh, I'm getting ready. I said, it was me. And he went to the washroom and I went in at the same time. And I said, what are you doing? And he had his shoes off and he was putting cash in his shoes, like a big wad of cash. I said, Bill, what are you doing? He said, well, so I got about $8,000 here. I'm putting them in my shoes and no one's gonna know I have it. I gotta bring it back in. And I'm like, okay, fair enough. And of course, anyone who knows you can bring in, 10,000 minus $1. You can wear it wrapped around your head and they're not going to say anything. It's fine. But the reason that story, it's a funny story, I think. And, but it also, you can relate that back into China and then with, the Vancouver real estate story, as well as San Francisco, Toronto, you name it. Capital is trying to get out of China. And the Chinese Communist Party are doing everything they can to try to slow it. So we all know the Bitcoin story in China, the manufacturing, it's or mining, I think they call it. It's flattened out. It's gone down, it's crashed, because they know that was simply a conduit to get US dollars out of the system. The E&O number that you're referring to, Rich, I mean, that's simply money shooting down to Hong Kong and coming out, through the Hong Kong banking system. So if you're able to get your money out of China, you're getting it out, and it has to go somewhere. They're not going to sit on it. So they're buying real estate, like in Canada and stuff like that. The risk that we have now so if that capital flow accelerates, for any reason, and there are 3 events now coming up in China that could affect it. I mean, we're already increasing now the potential for a conflict over Taiwan. There's lots of reason to say, hey, that will never happen, or the probability has increased to that happening. If for some reason it did happen, oh boy, you're going to see that reflected in financial markets, especially with capital flows. And then on top of that, we also have the Hong Kong banking system. They are losing, I can tell you firsthand, they are losing billions of dollars by the week. Again, money leaving the island, they're getting it out. It's going to Singapore, Australia, everywhere else you can think of, as long as it's getting out of the country. And the other thing with the Hong Kong-based banks, they really are, that's how China gets US dollars. The banks there, if the Americans wanted to, they could shut them off basically from the US dollar system. And just like that, the Chinese Hong Kong economy would collapse. So, Trump was considering that numerous times when he was in office. Every single time the pushback from Mnuchin was, hey, if you do that, you're going to crash the stock market. And he didn't want the stock market to crash. That's how he measured his approval rating. And, but you had a lot of these things are taking place. And then, this is all escalating to a point where something will happen. And we've also seen the Chinese, they had, what did they test for the day? They had a missile that went around the world.
Hypersonic
space. And do you know how close this thing came to its target when it landed?
Very close.
50 miles.
Right in Rich's backyard there.
That's pretty close. But my point is that there's a lot of things happening right now. And of course, we have the Beijing Olympics coming up next year. The Americans in the West, they have a huge incentive to make everything uncomfortable for the Chinese going into that. Whether it's an outright boycott, who knows? At the same time, you had the Americans and Australians and the Brits. They formed a submarine group, the AUKUS. So they're going to put them together. So there's a lot of stuff happening. There's geopolitics has shifted from the Middle East over to Asia. And so everyone is lined up, staring at the Chinese, and then they're staring back. And the one hole to get through that island chain, it is Taiwan. So, I think the probability of an incident there it is quite low, but it's no longer a zero event. And it just takes one small event, to lead to a crack in the system, which would affect capital flows, including what would happen back here in Canada.
Steve, I want to add something to you, just if I may, just circling back to the inflation thing. I think another thing that we I skipped over, and I think it's really, really important, is, for a long time, China was and is obviously, for a long time, they just manufactured goods and they immediately shipped them. And what you're seeing over the last 20 years is they actually are now some of the biggest buyer of goods. And, the cost of producing, this is anecdotal evidence, so forgive me, but look at, the tags on your shirt. 15, 20 years ago, it was China, and now it's Vietnam and Indonesia and Pakistan. And so, as China's become richer, and make no mistake, it has absolutely become richer, it's become more and more expensive to buy those goods. And it's become now not only a destination for exporting goods from, but importing goods to. And, like one of Apple's biggest markets for the iPhone was China, for example. And I think that what's really important is when you look at, for a long time, people would say China's exporting deflation. China's exporting deflation. And I think one of the things that we all sort of have to come to terms with is, I think that going forward, I think that story is either ending or beginning to end, or has already ended. And the way I would look at that is, if you look at durable goods, semi-manufactured goods, intermediate goods, you could see, or, if you look at information technology or communications, hardware stuff, you could see basically from 1996, which is the peak in that, index, to 2019. Again, it's important to stress there's nothing to do with COVID, in my view. And you can see it's actually starting to accelerate. It's because the Chinese are now, it's a much more expensive place to produce those goods. And also there's a middle class there that wants Teslas. They want iPhones, and they're now competing with the other middle class. They're now becoming the marginal buyer of all these goods. And I think that's like an important consideration when you think about inflation, whether it's Tiff Macklin and the Central Bank of Canada, whether it's, the Fed or whatever. And I think there's a lot of evidence to suggest that like Chinese deflationary impulse is sort of come to an end.
So these are, I mean, obviously all things we have to look at, because I think that, people are like, okay, China, you bring it all back. And it's like, there's so many moving pieces here that, obviously to try to forecast rates and the economy, I think a lot of this is going to depend on what's happening in China. I think the tension points, as we've sort of highlighted here, are ramping up. So something we'll kind of touch on here as we can keep an eye on in future shows. But I want to wrap this up and get to our fan mailbag.
Looking forward to this.
Me too.
So we got a couple questions in the Twitter sphere. We've got one from at Kyle_Line Otarki. He says, "What is your outlook for the reinvestment phase?" So Keith, I don't know, what's your outlook for the reinvestment phase?
So we'll do these sort of quick fires, so we don't, I don't want to drone on about QE. The reinvestment phase, that's going to continue. I'd be surprised if they ever got to the quantitative tightening phase. So I don't expect any changes with it. They could just target certain parts on maturities with it, but that's what will happen with it.
And
I'll quote Ben Bernanke and just say they're just going to let nominal GDP do the work. So as a share of your economy, it shrinks, but really they didn't do anything.
I love it. And then we've got one here from Raymond Wong asks, now that the Bank of Canada has ended QE, do you think other central banks will look into ending QE as well? And do you have an opinion on would the Bank of Canada restart the QE program at some point?
Yeah, so all the central banks are talking to each other, and they all want to move in harmony. So they, everyone will look at doing the same thing, as opposed to, I think, was it ending QE? I suspect it will never end, and if anything, it'll increase again at some point. So those are my thoughts.
Do you think that I've been following the Bank of Japan a little bit, right? Like they're kind of like QE on steroids for almost 2 decades now. But at some point, do we just reach where a point where the central banks own 100% of the government bond market?
Yeah, I think we're going to come into some kind of a debt jubilee at some point down the road. I'm not
My
sure
thought
how.
exactly.
I mean, the way that, let's use the Japanese as an example. So on it's the weekend, Saturday morning, they make an announcement that they are buying every single government bond that's issued, every single one. They buy it. Your account is then credited with a central bank digital currency. Have that as your pension fund. That's not what you have as an asset. And as soon as the Bank of Japan is when that trade settles, and then they just forgive the debt the next morning. So instantly the debt is gone. Everyone has this, but it's not as easy as that, because the next day, all of these pension funds, mutual funds, whoever's holding those bonds, all of a sudden they have this digital currency asset, and they have to do something with it. So what are they going to buy? They're going to buy equities, real estate, commodities. I mean, who knows? But you have to do something with it. But the system it's just
Shiba
not
Inu.
sustainable. It's what?
You're gonna buy Shiba Inu. It's that.
But this is why Bitcoin is such a good. Oh, sorry. I was going to say, this is why Bitcoin is such a fascinating existential threat to central bankers, right? This is why, on some level, I absolutely love it. Full disclosure, I own a little bit of it, but it's just, it's because it removes the power of money supply and interest rates away from central banks. And just to be clear, as a little mini history lesson, you do not need a central bank to run a successful economy. If you look at something called the Irish free banking era, I think is what it was called. It was in the late 1700s, early 1800s. You basically had a bunch of private banks in Ireland and parts of Scotland just run, and each of them had their own currency, and each of them had to work on trust. And how do you build trust? You build up your own reserves. You don't make stupid loans. And there was no overarching central bank and it was actually relatively successful. It was a short period of time because, England got involved and screwed things up, but you do not need to have a central bank to have a successful economy. Anyway, sorry, we'll save some more for that later.
You're definitely getting us kicked off YouTube now. All right, we'll leave it there. Thanks as always. We will be back for the Loonie Hour episode 4 next week. As always, if you guys have any questions, mailbag, send us a message on Twitter. It's the best way to reach us. As always, we'll see you next week.